Okay, thank you very much, Mike and Philip, for that great introduction, or two introductions. So Philip wants us to move straight into discussing drafting. I'm going to disappoint him, I'm afraid, for the moment, because I'd like to talk about principles and really ask, what is it that it appears that the Diverted Profits Tax is trying to do. Mike's already told us that it's for the UK to get a fair share of taxation. Without the benefit of that beforehand, I was trying to figure that out from first principles of actually looking at what the tax does to try and answer that question. So I'm going to spend a few minutes just talking about that. I would justify that even if we are interested in drafting, and I take Mike's point, this is all going to happen very quickly. It'd still be a good idea to know what it is that we're trying to do when we're trying to figure out what the drafting should be. So I'm hoping to at least address those kind of questions briefly. And in order to do that, I need to start and say, well, what is the international tax system as a whole trying to do? And I think probably the conventional view of it is that it's trying to tax active business income on a source basis and passive income on a residence basis. And as we all know, that that distinction creates a myriad of problems in trying to figure out what's active, what's passive, and what's residence and what's source. But let's start with that. And let's also take a step back and think about the broader public debate. What is it that the public is demanding of the politicians? And it seems to me there's two things. There's clearly, in the second of these points, there's clearly a general belief out there that multinationals are not paying their fair share of tax in some sense, and profits are being shifted to tax havens. I think there also appears to be a more specific thing, I think, in the comments that one hears in the public debate, for example, from the Public Accounts Committee, which is that there are many large companies making sales to UK customers, but their profits are not really arising in the UK. And the kind of points that the Public Accounts Committee talk about there, talking about companies like Amazon and maybe Google as well. So what are the responses of that in the tax community? Well, we have the BEPS project, and BEPS and the Diverted Profits Tax kind of share one aspect, I think, which is that they worry about economic substance. We should be taxing income where there's economic substance, and we shouldn't be trying to tax it where there isn't economic substance. And that may be quite a reasonable principle. My starting point of having a problem with that is that that's different from where we start. We start from the principle that passive income is taxed on a residence basis, not on a residence basis where there's economic substance. So I think what we're trying to do there is actually to overlay a different principle on top of where we start and say, okay, well now we want economic substance as well. But we're not saying we're going to get rid of those old principles and have a new one. We're just going to kind of overlay that on top, and it's really difficult to know what our principles are. So what are the UK trying to do? And I think this is a split infinitive here to delicately balance competition with combating avoidance. I think Mike's already talked about this, and perhaps in a common international framework. So if we go back all the way to 2010, the government's aim is clearly to have the most competitive corporate tax regime in the G20. That was really before the vast public debate about tax avoidance. The more recent response in 2013 was we were taking action in three areas. I think it's kind of worth noting this because this is very relevant for today. First, the competition point of when we want the UK to be competitive. Second, to clamp down on tax avoidance and aggressive tax planning. And third, to drive forward reform of the international tax framework. So that's in the background at least. So with that in mind, I thought it'd be useful just to look at one or two of the examples from the guidance for the Diverted Profits Tax and think about what it's trying to tell us about where the tax is going. So this is example one. For those of you who've looked at the guidance, it's hopefully a kind of relatively straightforward example. There's sorry for those people on the platform here, you can't see it. Oh, you've got some, okay, great. There's a foreign company, FCO, which is in some foreign jurisdiction, and it's selling to UK customers. And there's a UK company which is providing sales support, and it's providing essentially a commissioner arrangement. It's providing services up to, but not including, actually concluding the contract with the UK customer. And in the example, the UK company doesn't satisfy a threshold of permanent establishment, so it isn't a permanent establishment, but the other Diverted Profits Tax conditions are met, and I won't go into those now. So what kind of questions might be asked there? So my first question is, well, is this a diversion of profit? Now this, maybe this is just a semantic point, but this, what the Diverted Profits Tax is trying to do is to take this UK company and say we were going to treat this as if it's a permanent establishment, even though it isn't, because under existing rules it isn't a permanent establishment, but that's why you need a new tax in order to tax it as if it were. Whether we want to call that a diversion of profit or simply complying with the normal international tax framework, I think is something we could debate over drinks later, perhaps. Clearly related to this, we have a lot of action going on in the OECD about permanent establishment definition, and only yesterday there's a publication of all the responses, and I suspect that many people in the room had responded to the OECD's proposals on this. The second question that occurs to me then is, well, how much more income do we expect to collect if we treat this UK company as a permanent establishment as opposed to just an independent company, an independent subsidiary of the foreign company? And that strikes me as being, it's a question of, well, which kind of bit of the international tax system we're using. If it's an independent company, we'll be using transfer pricing rules to allocate profit to the UK company. If it's a permanent establishment, then we use PE attribution rules. If we take a step back and say, well, do we want an international tax system which says, the allocation of profit is going to depend on this legal form? From an economist standpoint, I'd say my starting point would be, actually, we would like to treat them in the same way. Why should the legal form determine, how much profit is allocated to the UK or outside of the UK? And in practice, it clearly is the case that in some cases we will get a different answer. I'm not an expert on PE attribution rules by a long, long way. It's not even clear to me, however, that in all cases we actually raise more revenue, possibly we might even raise less revenue. The second issue, and one that I want to come back to, is a kind of recharacterization issue, but I'm going to come back to that in a minute or two. There's a broader question, I think, which comes back to what I think is, in the public debate, which is companies are selling to UK customers and their profit is not being taxed. It's pretty clear that Diverted Profits Tax doesn't address that. So I think there's been some hype about this as being a Google tax, and this is going to solve many of the problems which the Public Accounts Committee has been concerned about. And if that's what the problem is, then it clearly doesn't. But let's move on. Another guidance example. This is the other part of the Diverted Profits Tax, really. So this is guidance example 3. There's a company, ACO, which wholly owns 2 other companies. One's in the UK, UK Co, and one's in a tax haven, HCO. The UK wants to use some plant and machinery, but instead of buying the plant and machinery directly, ACO gives some funds to HCO, and HCO buys this plant and machinery. So the plant and machinery is bought in the tax haven, funded by the parent company. HCO, basically there's no economic substance in HCO, so let's take that as given. It's no full-time staff, doesn't do anything else. All it does is buy some plant and machinery and it leases it to the UK company, UK Co. So the UK Co makes a lease payment to HCO, gets relief for the lease, and essentially there's no tax in HCO because it's a tax haven. So the question is, what should we do about that lease payment? Is that reasonable that the UK should give relief for that or not? From first principles, I'd want to say, well, I think it depends. So if ACO is a UK company, so if the holding company is British, and the activity is taking place in Britain, then this would seem like a clear case of tax avoidance. We're actually kind of making the purchase in a tax haven. We're kind of pretending that that's where the actual investment is taking place, which is really clearly taking place in the UK. So, if ACO is a UK resident company, I have no problem in saying this is something we should deal with.
Can we use the CFC rules on A?
Well, indeed, we might be able to use the CFC rules on A. But suppose ACO is not a resident company. Let's move on. Then it's less clear to me. So what would be the alternative to the plant and machinery being purchased by the tax haven company? Well, one possibility would be that the UK company would just lease it directly from the holding company, ACO. From the UK perspective, it doesn't seem to me to make any difference. There's a lease payment going out of the UK, it's going somewhere in the world. Whether it's taxed or not, we're in the place where it's received. doesn't seem to make any difference to the UK. You know, is it fair that, you know, that it should be taxed somewhere else or not? It's hard to say. It's not really part of the UK tax system, I think. So I pose the question: is it really the case that the UK tax treatment should really depend on whether this income is taxed somewhere else? There's a variant of this example which I'd like to talk about for a couple of minutes, which is it's the same kind of structure. In this case, the holding company undertakes some R&D and develops some intellectual property. And suppose that's in our high tax jurisdiction, but it transfers this intellectual property to the tax haven into HCO. Again, there's no economic substance in HCO, and the UK company now pays a royalty payment to HCO in return for using that intellectual property. So again, it's basically the same kind of example. Should the royalty be disallowed for UK tax purposes? Well, the general principle of the international tax system would say, yes, the royalty is deductible in the UK because it's a royalty payment. It should be taxable in A. It should be taxable in H where it's received. If it's not going to be taxed in H, then the first thing one would ask is, well, you know, that H is a wholly owned subsidiary of this foreign company ACO. It should be taxable under a CFC regime, or at least it may be taxable under a CFC regime. So again, the question is, in what sense is this profit diverted out of the UK as opposed to diverted out of the country where A comes from, country A? So the principle that I kind of came up with as what this was getting, the diverted profits tax is getting, is, you know, if this income is not being taxed anywhere, then we're going to tax it because we can. You know, that may or may not be a fair statement, but that's where it seemed to be leading. So I want three quick questions then. Are we sure? First of all, are we sure this income isn't being taxed anywhere else? Second, what about recharacterizations? And third, you know, actually, can we tax this, or will there be consequences? So, it could be possible double taxation. You know, what if when this IP was, suppose it was sold from ACO to the tax haven, and full amount of tax was paid in country A at the time, then there would have been tax paid on it. Would that be taken into account by the diverted profits tax? Or suppose that HCO then pays a dividend to its parent in country A. How quickly does it have to do it? If it pays a dividend straight away, then maybe the diverted profits tax will take account of that. What if it waits for several years? Will it still take account of that? So one question is, you know, how far can the diverted profits tax really look for taxation which is effectively on this underlying income stream? Next question is recharacterization. Suppose that the arrangement that we've got there, it wouldn't have taken place in the absence of the tax mismatch. I mean, it's there because, you know, we can pay a royalty to the tax haven, there's not going to be any tax on it. So, you know, the tax would then say we need to recharacterize that, but what are we going to put in its place? And there's some discussion in the documentation we've seen, and I'm a bit unsure about what the answer would be, but it's supposed to be a kind of just and reasonable alternative provision. So, but there's at least two possibilities here. You know, one alternative is to say, well, you know, if you couldn't pay a royalty to a tax haven, then you wouldn't pay a royalty at all. In which case, you know, the profit stays in the UK. The alternative would be to say that, well, if you're not paying it to the tax haven, you pay it directly to the holding company in country A, and that it would pay tax at country A's tax rate. And what's just and reasonable out of those two? I mean, if it really were the case that country A had developed this IP, then, you know, one might want to say that it's the second is more just and reasonable. Whether that's the intention of the diverted profits tax or not, I'm a bit unclear. Finally, can the UK tax this underlying income without any problems? Possibly, possibly not. You know, if it's Starbucks, then maybe probably yes. You know, Starbucks, it has to be in the UK because it wants to sell hot cups of coffee to people, and it's there on every street corner. It can't go anywhere else and do that. It's quite hard to sell hot coffee over the internet. But suppose it's a manufacturing company. It could do this manufacturing area. It's a manufacturing company paying a royalty for the IP involved in the manufacturing process. That manufacturing company could go somewhere else. Now, you know, as part of the UK's competitive agenda, we've reduced the tax rate overall, but this would, you know, for this particular form of income, this could potentially raise the tax rate from 0 to 25. And that's clearly going to make the UK less competitive than it was before the Diverted Profits Tax was here. And, that may have an effect on corporate location in the future. So, there is probably going to be some problem in terms of its effect on the competitiveness of the UK. And I will stop there, and I'm going to hand over to Heather Self, who's the next speaker.